Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the United States and why we are likely heading for a recession. Furthermore, we are going to discuss the implications of this recession on the S&P 500. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out Into the Cryptoverse Premium at intothecryptoverse.com, where you'll find access to a lot of the charts we're about to discuss, as well as many more. Now, if you were unfamiliar with some of the charts that we talk about in this video, I will remind you that you can find further discussions on them on the macroeconomics playlist for this channel, where we will spend a good deal of time talking about a lot of the indicators that we're going to discuss. However, I felt it necessary to go through all of them in a single video so that we can really try and understand why the United States is likely heading for a recession. Now, the content of this video will include things like the real gross domestic product and the quarterly change, the effective U.S. interest rate, the unemployment rate, the Treasury yield curve, and the inversion of the Treasury yield curve. We will overlay a lot of these indicators together to try to take away some key points from that. And then we will finalize things by looking at how this affects the stock market. All right, let's go ahead and jump in. So the first thing I want to address is the academic argument that we are already in a recession. And I myself have said many times in the first half of 2022 that we were already in a recession. And the reason for this is because we saw 2 consecutive quarters of negative GDP. And normally, this would correspond with a recession. Now, we could argue there's many reasons why it has not been declared a recession, whether it be political or whether it be people living in denial. However, there are some counter arguments that economists could make to say that we have not yet entered a recession. However, it's coming relatively soon. Okay. And I want to talk about in this video. So if you're not familiar with US real GDP, this is what it looks like. So this is what it looks like. And this is the quarterly change. And what you'll notice if we zoom in to the 2 most recent quarters, it was negative. Now, normally, this would constitute a recession. On this chart, there are several gray shaded regions. On this chart and the charts that we'll discuss in this video, the gray shaded regions represent prior recessions in the United States. You can see that when real GDP quarterly, when the quarterly change goes negative, it corresponds to a recession. So, all things considered, it would make sense to say this should be a recession already. But one of the interesting things, though, is that in Q3 of 2022, we are now coming out of that academic argument for a recession. And what's more interesting is that despite the fact that we had 2 consecutive quarters of negative GDP, the overall all-time high GDP has now just occurred. And we just went higher than we went earlier this year before we had those 2 consecutive quarters of negative GDP. So this is an interesting development. I want to talk about why there are a lot of economic reasons, or so at least some reasons, why you could argue that the recession that a lot of people are discussing has not actually yet occurred, other than, say, like on paper with 2 consecutive quarters of negative GDP. One of these main reasons is the low unemployment rate. Now, there are a lot of counterpoints to the unemployment rate. We could talk about the validity of the data and so on and so forth. But if you just look at the data for what it is and look at, again, the gray shaded regions on this chart, you will notice that when the unemployment rate is going up, that is where we get recessions. That is where the pain is really felt in the United States economy. It is not simple. It's probably not enough to just look at the change, the quarterly change in real GDP, and argue that that necessarily constitute a recession if you can see that it normally would correspond to a recession, but that's one data point. And if you pull up the unemployment rate, you can also see that when it goes up, that's what corresponds to a recession. So I don't really want to debate too much as to whether, we were in a recession already in 2022, because I fully understand the arguments for it, and I'm not really here to dismiss it. What I am here to say is that by a lot of other metrics, we are likely about to head into a recession, and it is likely going to be relatively painful for the United States economy. If you look at the unemployment rate right now, it still remains relatively low. Okay, and it's currently sitting at 3.5%. This is a historic low this cycle. In fact, to find unemployment lower than 3.5%, you would have to go back all the way to the 1960s and 70s, early 70s, to find when the unemployment rate was this low. However, to go back to the 70s would also be to go back to a period where we had high inflation. If you go take a look at inflation year over year, this is headline inflation year over year in the United States, you can see that inflation has just absolutely skyrocketed over the last several months, and starting all the way back into 2021. In order to find a period where inflation was this high, again, you would have to go back all the way to the early 1980s, and then you would also find a similar period in the early 1970s. What you will also notice is that recessions tend to occur around periods of high inflation or just after it. Why is that? Why do we see recessions after periods of high inflation? Well, first of all, inflation can hit a lot of Americans pretty hard. If it costs a lot more money just to get everyday necessities, you're not going to have as much discretionary spending for other things, and therefore it is going to feel very, very challenging. Also, when the unemployment rate goes up, a lot of people lose their jobs, and of course that also is felt in the economy as well. But what you'll notice is that when inflation goes up, we tend to have a recession right after it or during that time. Why is that? Again, it takes a recession typically to get us out of it. But why do we need a recession to get out of it? Or what causes that recession in the first place? Is it just high inflation? Not really. What really I think we need to look at is the federal funds rate, right? So interest rates. Interest rates are going up right now at a pace that we have never seen. Okay, now interest rates have gone up to much higher levels before, but they've never really increased this quickly. And the economy is starting to feel this in a lot of measurable ways. There's a lot of companies that are coming out with earnings reports that are a lot less than, or a lot, well below expectations, and they're selling off relatively quickly. We saw this happen, we've seen this happen many times before, and it's usually not a great sign for what's to come over the next several months. The interest rate right now for the United States is 3.25%. Okay, for the Fed funds rate, it's 3.25%. We're likely going to see another 75 basis point rate hike at the next meeting. The next meeting is next week. If we go look at market expectations for next week, and we go look at November, there's currently an 86.9% chance that we're going to get another 75 basis point rate hike, and a 13.1% chance that we're going to get another 50 basis point rate hike. Clearly, the market is pricing in a 75 basis point rate hike. Furthermore, in December, the market is currently pricing in another 50 basis point rate hike to end the year at 4.5%. If you go skip ahead to March, there's a good chance that we're going to be at between 4.75% to 5% for the Fed funds rate, meaning that the terminal rate could be 5%. Right? It could be 5%. There's a chance it could be that high. There's also a chance it might not make it that far, which I do think we will eventually get to 5% if I'm just, projecting my own opinion. And there is a risk that it could actually go higher. One of the reasons to not completely discount the idea of it going higher than 5% is if you actually go look at interest rates and inflation it tells a somewhat interesting story. So this chart here shows recessions shaded in gray, United States inflation, which is the green line, the US effective interest rate, which is the blue line. You may notice, okay, and let's really watch, or let's really look at this relatively closely. You may notice that it typically takes the effective interest rate going above headline inflation to actually bring that inflation back down. You can see back in the 70s there were 3 spikes with inflation. Okay? Let me show you a bit closer. I'm going to hide interest rates for a minute. You see the spike in inflation in the early 1970s, and then again in the mid 70s, and then again in the early 80s. All 3 of these led to recessions. This one over here led to 2 recessions, but all 3 of them led to recessions. What's interesting is if you overlay the interest rates that the Fed had to go to, every single time the interest rate went above headline inflation before inflation actually started to come down in any meaningful way. It's kind of crazy to think about to some degree because headline inflation right now is currently sitting at over 8%. Now, I'm not saying that the effective interest rate by the Fed is going to go over 8%, but because of a trend like this, I think it's at least reasonable to assume that the terminal rate could be above 5%. However, if we are going to have a terminal rate above 5%, the way that we get there might not be in, say, a linear fashion. The Fed might raise interest rates up to a certain level, let's say 5%, and then hold it there. And if inflation is stubborn and does not come back down, then perhaps they might start raising interest rates again rather than cutting them. This is a possibility. I don't know that it's the most likely possibility, but it's at least a possibility to consider because at least when you look back at the last period, the last decade we had where we had high inflation, it took the interest rates going above headline CPI for us to actually see inflation come back down. I would like to see inflation come back down because I do think that whenever it does come back down, which could be a long time, that will lead to our next phase of economic expansion in the United States. Of course, until we get supply chain issues resolved and until inflation comes back down, we are likely not going to see this. So, we've touched on real GDP and the quarterly change. We've talked about the academic argument that you could say we are already in a recession or we were in one for the first half of 2022, and that's now no longer the case since the most recent quarter came in at positive GDP. So there's that. We've talked about the interest rates and how quickly the Fed is raising interest rates right now. The problem with raising interest rates at this phase is that normally, and I'm going to overlay the S&P 500, normally when the Fed raises interest rates, they do it when the economy is relatively strong and when the stock market is going up. They usually start cutting rates when the market is starting to show weakness. Okay? You can see that over here. In the dot-com crash, they started cutting rates the minute we started showing weakness. During the financial crisis, they started cutting rates the minute we started to show weakness. In 2020, they started cutting rates again the minute we started to show weakness. The economy and the stock market are showing weakness right now, but the Fed is raising interest rates. Just think about that for a minute. I mean, this is not, this is arguably to some degree somewhat unprecedented. Typically, the Fed lowers interest rates when the economy starts to fall off a cliff, not the other way around, right? They don't usually raise interest rates into a slowing economy. But you could argue that mistakes in Fed policy are what usually lead to recessions. And it is hard to imagine that we will be able to avoid a recession given the data that we're looking at. And just to reiterate, I'm going to continue on to a few other things. This includes inflation remaining somewhat sticky. This includes the unemployment rate remaining relatively low. Now, you might say, what does that have to do with a recession? Well, as I said before, once the unemployment rate starts to go up, I do think a recession will be declared. I think it'll probably be declared sometime in 2023. That might backdate it a while, Might take until mid 2023 to declare it, or even late 2023 before they declare it, but I do think they'll backdate it some. This is something that the Fed wants to see happen. They have said this many times. They have been adamant that they want to see the softening of labor market conditions. When you have unemployment this low and demand is still through the roof, it makes it very difficult for inflation to come back down in a linear way. It acts more stochastically, where instead of just coming down in a linear fashion, it just sort of goes up and down for a while, right? It doesn't really go anywhere. Okay, it's not what you would want to see. And because it's not what we want to see, the Fed is forced, at least so far, to continue raising interest rates. And I believe they are going to continue raising interest rates until the unemployment rate starts to go up. And once the unemployment rate starts to go up, that's when we get our recession. Okay? Now, before I get to the implications on the stock market, I want to talk about one or two more things. The Treasury yield curve. We've talked about this many times. This is what the yield curve currently looks like. Looks pretty weird, okay? If you're not familiar with the yield curve, it should normally look something like this. Well, why is that? Well, this is a function of time. So these are like 1 month Treasury, 2 month, 3 month, 6 month, a year, 2, all the way up to 30 years. And it would make sense that the yield annually would be higher for longer Treasuries. That makes sense, okay? Like we can rationalize like, oh, wait, all right, well, if I'm gonna put my money into something for 5 years, I would expect a higher annual return than if I only were gonna do it for 2 years because I'm putting it in for a longer period of time. But occasionally you get the yield curve looking somewhat weird, like this. When has it previously looked like that? Scroll back through time. The yield curve started to invert before the financial crisis in 2007, 2009. It inverted before the recession in the dot-com crash. And you can also see some inversions going on all the way back into early 1990s. I don't have the data going much further back than this, but you can see it's really looks a little bit weird during that time frame right before the recession in the early 1990s. This is what it looks like, okay? This is what it looks like now. You can get a higher yield right now on a 1-year Treasury than you could on a 10-year Treasury. Right, think about that. Like 1 year gives you a higher yield than a 10-year. Annually, of course. So the thing to consider, or what you might naturally think about, is, well, what does the inversion mean? What is it? Does it have a pretty good track record? Well, we can go look at two examples. The first thing we're going to look at is the inversion of the 2-year and the 10-year, and then we're going to look at the 3-month and the 10-year. So if we look at the spread on the 10-year and the 2-year, you can see when it goes below 0. So when it goes below 0, it means the 2-year is inverting the 10-year, meaning you can get a higher yield for the 2-year than the 10 annually. When it inverts, it typically leads to a recession. You can see that it inverted over here in 2000, and we ended up getting a recession. It inverted over here in the financial crisis or before it, and we got a recession. Look at the deep inversion yet again. This inversion, by the way, is to the same extent so far that we saw before the dot-com crash. Right? The main difference is that this sort of inversion bottomed at this level when the market was at its top. Now it's at this level and the market's already down like what, 20 to 30%. I mean, we're in the middle of a rally right now, so it's currently off its bottom, but these are just observations, right? That this was at the extent to which this inverted occurred at the top. That's when the Fed started cutting interest rates to try to limit the pain, and we still went down. Now we're already down here, but the market has already corrected, and the Fed is raising interest rates because of high inflation. So you begin to see it's going to be very difficult for us to avoid a recession. This indicator has a fairly good track record. An indicator that has an even better track record than the 2-year and the 10-year is the 3-month and the 10-year. And the reason why I actually do prefer this one a little bit better is because once it inverts, it doesn't take that long for the recession to occur. So, for instance, you can see here it inverted in 2000, July of 2000, and in less than a year, we were in a recession. In less than a year. This one took a little bit longer. '06, August of '06, it inverted, and then it took until October, November '07. So about a year before, the recession was declared. Again, inverted in 2019. We had that very brief recession in 2020. The reason it didn't last very long is because the Fed printed trillions of dollars, and now we're paying for it, right? Now we're paying for it. It's inverted again, okay? So, when I've made prior videos on the 3-month and the 10-year, it wasn't really inverted, or if it was only just barely inverted. You can see this is starting to really move to the downside. Now, it could go a lot further than this, and I think it will. But if you zoom in here, it's taking the plunge, right? The 3-month and the 10-year has inverted. So what it means to me is that likely within about a year, we're probably going to see a recession in the United States. And why is that important? Well, we're going to talk about the relation to the stock market, but generally speaking, the stock market bottoms during the recession for all but like one case that I'll show you. Okay, except for like one case that I'll show you. And this is why we're in a period right now where I've said for the entire year basically that cash is king this year. And you know what? Cash is not going to always be king. It certainly isn't. And if you're like me and you've just been trying to stack cash this year, you've missed out on a lot of bear market rallies, and these counter trend rallies can be really difficult to sort of sit on the sidelines for the most part. I'm somewhat hedged the other direction as well, but if you're stacking cash for a long time and you see these bear market rallies, it can constantly leave you wondering, what happens if it doesn't go down further and you sort of miss the boat. But I think it is at least worthwhile to look at some of these indicators to try to figure out, is the S&P 500 bottom in, or is it a long ways off? The more important component, in my opinion, to the bottom of the S&P 500 is not the level that it occurs, but when it occurs. It doesn't really matter to me what level it goes, because whatever I get in, at whatever level I decide to get in, that's where I'm going to measure things from anyways. It doesn't really matter what level that is, whether it's 3,000, whether it's 2,500, whether it's 3,400. It's kind of irrelevant to me. It's more important, I think, to measure when it occurs, not at what price it actually reaches. I hope that is somewhat, or at least somewhat makes sense. Now, this chart here shows the S&P 500 in every recession going all the way back to the Great Depression, basically. Okay? What you'll notice is that in every single recession where we had a bear market, the bottom occurred during the recession, except for one case. Okay, so we'll talk about that one case, but first, just look at a lot of these bear markets. Look at the 70s and the early 80s when we had periods of high inflation. Every single bear market ended in the recession. Let me overlay the S&P 500 on here as well. Or sorry, not the S&P 500. Let me overlay, let me get rid of this. Let me overlay inflation. That's what I want to do. What you'll know, or sorry, I clicked on the wrong one. That's just CPI. I want to get it year over year. So let me scroll down US inflation. Sorry, my mouse is acting up a little bit. All right, so this is US inflation. You'll see that every time inflation was going up, the US had to raise interest rates, right? To get inflation to come back down, we had to raise interest rates. Why don't I go ahead and overlay that one too while I'm at it, right? Let's overlay the effective US interest rate. So interest rates had to go up when inflation was going up. Eventually, and I can also switch this to the same axis as inflation and interest rates, put them on the same axis so you can see the relationship. Interest rates had to go up to combat inflation. we eventually got sent into a recession. Why did we go into a recession? You guys know the unemployment rate. This was when the unemployment rate was skyrocketing. Unemployment rate skyrockets while the US raises interest rates to combat soaring inflation. The S&P 500 bottoms during the recession. This was in the late 60s, early 70s. Again, inflation goes up. In order to combat inflation, we have to raise interest rates. That typically leads to unemployment skyrocketing. When unemployment skyrockets, we get a recession. The S&P 500 bottoms during the recession. Right? Again, you go to the 80s. Inflation soars. Interest rates go up to combat inflation. Because of that, the U.S. unemployment rate skyrockets. When the U.S. unemployment rate skyrockets, we get a recession. The S&P 500 bottoms during the recession. You can see this play out many times, right? This is not just a single thing that occurred. This has happened many times in the past where once the unemployment rate started to go up, that's where we got the recession. You should note that the S&P 500 usually bottoms before unemployment rate peaks. Let me show you what I mean. So I'm going to hide a few of these. Now we're just looking at the stock market, the S&P 500, and the unemployment rate. You'll notice that the unemployment rate peaks after the S&P 500 bottoms, right? Unemployment rate peaks after the S&P 500 is bottomed. More or less every single time. Maybe there's a couple examples where it doesn't, but usually the S&P 500 is bottoming before unemployment peaks. Why is that? Well, again, the stock market is forward-looking, okay? The stock market is forward-looking. It's not, once you actually have that peak in unemployment, markets are rather sophisticated, and market participants start pricing this stuff in. So by the time it's peaked, it was priced in before, and the market is already assuming it's going to start going back down, okay? And that is where the S&P 500 bottoms. It's when, at least usually, it's when it's before unemployment peaks, during the recession. The reason we got into the recession was because the Fed was raising interest rates a lot of times to combat inflation. This is not always the reason we go into a recession, right? Inflation's not always there, and it's not the only reason that we go into a recession. But there are a lot of reasons when we do go into a recession, it's because inflation is high. We saw that in the 40s, we saw that in the 70s, and you can see, even if you go back, even if you go back over here, when unemployment was going up, again, the S&P 500 bottoms during the recession before unemployment peaks. This happens so many times. So, how do we wrap this video up, right? What's one way that we can, sort of wrap this up? Well, there are a lot of companies that are showing huge losses recently in earnings. Or their earnings are coming in far below expectations. We already saw Meta, we saw even just Amazon today, and Apple actually came in somewhat okay, but a lot of companies are really starting to come in and show that their earnings are relatively lackluster. So you're starting to see the cracks form. Now, what I want to show to sort of finalize the video is to look at this bear market compared to the prior bear markets. This is what it looks like. All right? Makes sense? No. Let's clean this up a little bit. First of all, this is a 2022 bear market. All right? Looks like a structural bear market. You see the lower highs and the lower lows. Okay? The lower highs and the lower lows. What happens if we were to compare this directly to prior bear markets? Let's go look at the financial crisis, for instance. This is what it looks like. It looks pretty similar to what we've played out so far this bear market, right? It doesn't mean we have to have a capitulation in a couple months, but it also doesn't mean we won't. Every bear market plays out somewhat differently, but this is what it currently looks like. Would this make sense? Well, if you think about it, as I said before, we're likely not going to be in a declared recession until 2023, which is likely a good chance that's when the stock market will bottom. Okay? At some point during the recession, whenever that's declared. That's likely where the recession, or that's likely where the stock market will bottom, and it's also likely where unemployment will get close to peaking. Okay, it's hard to know if it's going to all happen in 2023 or maybe early 2024. It depends on how quickly these things play out. But this bear market from the financial crisis lasted 517 days. We're currently about 300 days into the one we're in right now, and maybe just below 300 days. So another couple hundred days seems reasonable. Like, it seems like a plausible scenario that we could have another couple hundred days of a bear market, and it would be in general expectations with what we expect from the other charts that we looked at. If we compare it to the .com bear market, this is what it looks like. This one lasted a lot longer. It lasted 927 days, meaning if that's the case, we're only a third of the way through the bear market if it has to last as long as the .com bear market, which I know is kind of crazy to think about, but it's a possibility, right? Like, these are possibilities whether we want to believe it or not. It's just the truth. It's not to say that it has to play out. It's not to say that it will play out, or it's not even to say that I think it will play out. It's just, it is what it is. And what it is a potential outcome that we've seen in the past when we also didn't have high inflation and we had a Fed that was cutting interest rates, not raising them. So an important consideration to make. So it would generally be in line with expectations that you could have a bear market last a while longer and eventually see a bottom some point during the recession. Now, they're not all doom and gloom. Some of these bear markets, while they might last a lot longer, they don't actually go that much lower. So if you look at the one from the 1980s, it lasted a lot longer, about twice as long as the current one has lasted so far, but it didn't actually go that much lower than where the current one is right now. So that's something to consider as well. And that's why I said, early on in this video, it's not always about how far down it goes. It's more or less about when it bottoms. Now, I'm not going to pretend like I'm going to be able to predict exactly when the S&P 500 is bottomed. I don't know, if anyone will be able to actually predict the day in which it bottoms. A lot of people would argue that the bottom is already in. However, so far this year, as we've declared cash is king, all of the rallies have been short-lived, and we ultimately put in new lows. If you go look at the 73, 74 bear market, which was also during a period of high inflation, we could go sideways for a while before earnings really continue to disappoint, and then maybe you get a second leg down later on, sometime in 2023. Again, if it plays out like the financial crisis, it means that, we see a bounce, or we're in the bounce. Maybe it lasts for another month or so, and then it comes back down. One way that this could maybe play out is if you had the Fed give some dovish talk or something, and then everyone starts talking about a pivot, even though they're still raising interest rates, and then we get to the end of the year and they're still raising interest rates, and the pivot that was promised that was going to save everyone's portfolio is not actually true, and then everyone realizes it, and then the market goes down. That's one way that one could play out. One way that this one could play out is if the Fed gives dovish talk and we go up for a while, and then we do get bad earnings, but somehow inflation comes back down before the unemployment rate starts to spike. And then perhaps it doesn't have to get as bad. But these are all considerations that you should make. What's interesting, if you overlay a lot of these bear markets, let's say the one from like the late 60s and early 70s where we did have some high inflation, the one from the 70s, the one from the 80s, the .com crash, the financial crisis, the one from 1946 to 1949, which didn't go that much lower but lasted a lot longer. This is where we are, right? This is where we are. This is where a lot of these other structural or cyclical bear markets, how long they went. So, with this in mind, knowing that the Fed will likely raise interest rates still into a slowing economy to combat inflation, to get the unemployment rate higher, to reduce demand because they can't fix the supply chain issues, which will likely send us into a recession. And it is in the recession that the S&P 500 normally bottoms. So not always, right? I did say there was one time where it didn't. The dot-com crash. It actually bottomed after the recession. If you think back to what was going on in 2001, maybe that would give you some insight into why we continued going down after it seemed like the worst was over. But these are all important considerations for you to think about. I'm not here just to spread doom and gloom. I really am not. But I do want people to at least consider these things before YOLOing all their money in, because it's one way to just completely lose your money in bear markets. It's just like YOLO in on every single bear market rally. Again, none of this is financial advice. I just want you to look at some of these indicators and make the decision for yourself how you think it makes the most sense to navigate financial markets and what risk you are willing to take on. Again, if you guys want access to all these charts and tons of other charts as well on the website, go check it out, intothecryptoverse.com. It's mostly about crypto, I warn you, because that's where a lot of the gains are made. But these are all, important things to consider. The one thing I'll leave you with, I was thinking about this earlier, maybe a little a fun fact I was thinking about. Bitcoin is one of the main things this channel has been around about for a long time. And what's interesting is that this peak here was right around 64 to 65K, right? It almost went to 65K. And then this one went to 69K, about half a year later, right? About half a year later. What I find somewhat interesting is if you go over to core inflation, it's almost mimicking the double peak of Bitcoin, right? Even down to the actual number, right? Like 6.4 and then 6.5 in March. 6.5 in March. 6.4 in February. And then it came down. I think Bitcoin came down. And then Bitcoin went back up to 69K. Core inflation right now is 6.6%. So it'd be kind of funny if it peaked out at like 6.8 or 6.9%, and we sort of had a double peak on core inflation. I think that's what's going to happen, honestly. I think core inflation, you're likely going to see some type of double peak on it. Not that dissimilar from what Bitcoin did, where it went just a bit higher. But I do think you will see core inflation come down considerably in 2023. And then we'll just have to live with the effects of what the Fed has done. We'll have to go into the recession, try to find a bottom on the S&P 500, and begin a new phase of economic expansion. That'll wrap it up for this video. Make sure you subscribe if you're not subscribed. Give the video a thumbs up. I'll see you guys next time. Bye.